All right. Thank you so much for the introduction, and the first few panels now and the discussions that we've had have been truly illuminating on the science, and now we get to move from the science into the application from the insurance perspective and even population migration. You heard Secretary Kerry talk about insurance and migration. You heard the science folks talk about insurance and the pricing of it, and now we're actually going to bring 3 world-class experts to talk about that exact topic. We're going to cover insurance pricing, insurance availability, and even the downstream impacts of population migration. So to do that, we'll have a moderator come out, my good friend Bill Cherney. I'll give an introduction to Bill, and he'll come out with the panel. Same theme as last time, where we'll have 3 TED Talks, the 10-minute presentation, followed by the panel discussion. So I'll introduce Bill, and then he can introduce the panel. So Bill is the former president of Extreme Event Solution, Vera's Catastrophe Modeling Division, which was formerly known as AIR, as many of you would know it. Bill led that from 2016 to 2023, and he currently serves as the board of trustees for Geohazards International, a nonprofit helping at-risk communities build disaster resilience. So please join me in welcoming Bill and our panelists.
Morning to everyone. Thank you for coming to this important event. I'm very honored to be moderating this panel. So our first presenter will be Spencer Glendon, who's the founder of Probable Futures. It's a nonprofit initiative that aims to change how we think about, talk about, and plan for the future of our society and our planet. And for many years, he conducted and directed research as a partner at Wellington Management. Following that, we'll have Dr. Carolyn Kuski. She's the Assistant Vice President of Economics and Policy at the Environmental Defense Fund and the founder of Insurance for Good. She serves on the Federal Advisory Committee on Insurance at the U.S. Department of Treasury, which is the high-level advisory board on catastrophic risk management, and at the OECD, and is the vice chair of California's Climate Insurance Working Group. And then finally, we'll have Dr. Jeremy Porter. He's a founding member of First Street. He leads their climate implications research. He creates economic models studying how climate change affects property values, migration, commercial viability, and risk transfer. With over 125 peer-reviewed works, he's often quoted in major outlets like the New York Times, the Wall Street Journal, and the Washington Post. So each of our experts will give a 10-minute presentation, and then we'll follow up with a panel discussion. So Spencer, I'll ask you to begin.
Great. I will stand up. Do you all want to stand up once, just to loosen your legs? All right. I should have a big purple slide. Great. All right. We are here to talk about climate change and property. And that's very suitable because property exists historically only in an unchanging climate. What I mean by that is that a stable climate enabled settlement, and a settlement is what enabled property. What I mean by that? Let's look at some data, because what you really came to do here today was see graphs. And I'm going back here 1 million years, so you take the graphs that were there shown before of temperature, just taking those same graphs much further back to 1 million years, and from 1 million to 10,000 years ago, what you see here is the atmospheric temperature varied from -5 to +5, around that same mean of the early 19th century, the beginning of industrialization. And the first humans were born 200,000 years ago, just like you and me, and they did not settle. For 190,000 years, they did not settle. And then they settled, and the graph tells us why. The climate became mild and predictable. And once it's predictable, you stop following the plants, you stop following the nice weather, you stop following other things and responding, you start planning, which is, in essence, the core of property. So why are we gathered here today? Because there are 2 other possibilities in the green band. One is, we know from much earlier on, it was too hot for big mammals. We have a pretty limited temperature band, big mammals. But the other is, we are now outside the green band. At 1.5 degrees C, it's warmer than it's ever been. It's changing quite quickly. And so we're here to talk about the implications of the end of that stability. And you might think, was it really that stable? Is that a fudge? You actually know the answer already, because you can look back at history, and there were the same plants in the same places for a long time. They grew olives in Greece thousands of years ago. Today, 20% of Greek farmland is olives. And at 1.5 degrees, those olives are really struggling because winters are warmer and wetter than they ever were before. And summers are hotter and drier than they ever were before. For the first time, it's hard to grow olives. So that's a risk to olives. We're here to talk about risk. What is the history of risk? I'm not going to go back 1,000,000 years, but I'm going to go back a long way. So I'm going to start with that 200,000 years ago. It's likely that people figured out how to manage risk even early on, but they didn't turn it into insurance companies for a very long time. And actually, the root of the insurance company is in boats. All of historical roots of modern insurance are from boats. And that's very important as a root of this whole problem we have now. Boats are very different than property. So what happened in Lloyd's Coffee House? So Lloyd's Coffee House in London was a place where boat owners got together and shared information about their boats. And what they realized was they could start pooling risk. They could share each other's risk for the boats that were out at sea and do better, be better off, minimize their risk, actually increase the pool of capital, could get more boats out on the water. What do? They ask questions, due diligence. Who's the captain? Who's the crew? What's it made of? Where's it going? The kind of things that bankers supposedly do, that investors supposedly do. But actually, what happened was from this genesis in Lloyd's, people said, you know, we could do this same thing for buildings. We could stop insuring boats. We could insure buildings with this same kind of due diligence. And why is Lloyd's relevant? Lloyd's is the beginning of the insurance company, the dedicated property insurance company. And so for the next 170 years, insurance companies took on more and more risk until the Great Chicago Fire, which looks an awful lot like the LA fires. And what happened after the Great Chicago Fire was that insurance companies said, no more. We're not taking these risks. We will not insure a city anywhere. We will not insure any building in a city until that city has new regulations, until it has a fire department, until it has fire codes, until it has building codes. Someone else has to take that risk. We'll take the residual little risk, but we're not taking this systemic risk. Risks are too big, too correlated, too unpredictable. If the city would make them small, uncorrelated, and predictable, we'll take the risk. And what you see is that that stability is baked into every part of the insurance industry. On the basis of property fire insurance, people assumed the climate wouldn't change. They didn't know they were making that assumption, but they assumed the climate wouldn't change. So this is a histogram of temperature in a particular place. I've anonymized it, but you could do it for anywhere. So this is, over time, in the past, what was the climate like? Well, there were some cold winters on the left side, and the right tail was pretty small for hot. This is what it was like in that place. Same with rainfall. We have observed rainfall. Mild rain was more likely than serious rain, and then there was the outlier event on the right, the 1 in a 100-year storm. And so what did people do? We had building codes, we had regulation, we had norms, we had engineering standards that said, this is what we'll do for the 99th percentile, for the range, this is how we'll build society. And then there's a little bit on the outside. Same with storm sewers, things like that. So what did this look like? Storm sewers, power systems, asphalt. The grade of asphalt was based on the past climate. Everything was based on the past climate. Farmers plant based on historical data, and they buy insurance based on historical data. A shifting distribution is a real problem for everybody. So in the past, what happened when it was hotter or colder than the building codes planned for? It was a little hot or a little cold. Maybe a pipe froze. Maybe you didn't sleep well. What happens now? May not look like a big shift, but that tail is much bigger. In fact, it goes way out off the graph, in fact. Nobody's prepared for that. In this city, mortality goes way up when it gets outside the past bands. What does that look like in Florida? So this is from probablefutures.org. What we did was make this data available, much in the same way First Street has, for free in the public, and it's global. And you can see, for example, wet bulb temperature. This is 82 degrees C wet bulb, the nastiest day in Orlando in the past. This little box, which is, I think most of you can probably see, shows in an average year, this kind of temperature humidity combo happened once a year, in a warmer year, 8 times. This is the late 20th century, 0.5 degrees C. This is about 10 years ago when we were at 1 degree C. Now the range has gone, instead of 0 to 8, it's 0 to 19. At 1.5, it's 0 to 39. It's dangerous for kids to be outside, people to work outside. At 2 degrees C, it's 0 to 59. That distribution's gotten super wide and funky, and we are unprepared for it. We're still building with the same building codes, same risks. So what happens now when the rainfall makes a tail like this? Increased frequency, increased severity, increased correlations. The insurance just doesn't want any part of that. And what you see is that that well-behaved climate with moderate outcomes that we called severe enabled all kinds of blindness, all kinds of ignorance. It's an insurance problem. Architects didn't study climate. Building inspectors didn't study climate. Bankers didn't study climate. I oversaw research at one of the biggest investment firms in the world. Nobody paid attention. It's the best forecast humans have ever used. Nobody's using it. So you didn't update the building codes. You didn't have big losses, so you could use cheap building materials. You could just keep looking back to look forward. All of those things are now no longer true. And you couldn't just outsource to Verisk. For me, when I learned that almost none of the insurance companies did their own risk modeling, they just outsourced it to either RMS or Verisk, I knew how deep this problem was. And there are a lot of bankers in the room, and you've been assuming climate stability without knowing it by offering 30-year mortgages and only requiring 1 year of insurance and calling that a match. You've assumed the insurance would be stable. Look at those spreadsheets of a property. It's just this year's insurance cost times 1.02 out to the future. So what are the ingredients for a deteriorating insurance market? You change the distribution, tails get fatter, more unpredictable, events become correlated, and these are the things that are now happening. So what do we need? We need a new Lloyd's. We need to start over and start talking to each other, include more kinds of people, have due diligence not just be done by experts, but by everybody. And so it shouldn't just be a bunch of old white guys in wigs. There are a lot of old white guys here, and some of you may be in wigs, but we actually need a diverse group of people, of citizens, to talk about risk in new ways. And that's why I'm excited to be involved here, and I'm excited for what First Street has done to engender that conversation. Thank you.
Thanks, Spencer. What do I hit, the green thing?
You just hit that one.
That one. Okay. Thank you. It is great to be here with everyone. I'm going to build on Spencer's comments and say a little bit more about the impacts of climate change in the insurance industry and what we're seeing right now. But I wanted to start with a little bit motivating why we should care about insurance, why what happens in insurance markets matters. And of course, insurance underpins so much economic activity that wouldn't take place if people had to bear those risks themselves, from complicated medical procedures to building major infrastructure to getting a mortgage. You can't do any of those things without insurance. My work, though, tends to focus on households and communities, and what do we see there? We see this growing body of research evidence that insurance is really critical to people's recoveries. We see in our own work that households who have insurance have fewer unmet needs, have fewer financial burdens in both the short and the longer run post-disaster. Other work shows that insured households have faster recoveries, they're more likely to rebuild. Lack of insurance widens income inequality post-disaster, and there's a robust body of research that when households do not have the financial resources they need to recover, it has negative spillovers into all aspects of life for a very long time. So insurance is really critical for households, but it's more than households. We also have really good research that it has benefits to the entire community. We see in our own studies that as more people in a community are insured, after a disaster, you see visitations to local businesses go up because people can more quickly and fully participate in their local economy. We also see and work with Fannie Mae that when households are insured, when borrowers are insured, it protects the lender and it protects the GSEs against poor mortgage market outcomes. So all these benefits are why it's really troubling when people can't get the insurance coverage they need or can't afford it. And we're right now at this moment in time where as disaster risks are increasing, that financial protection is more important than ever, and yet that same increase in risk is stressing our markets, making it harder to get and more expensive. The last few years, I'm sure many of you have been seeing the news coverage of a lot of concerning trends. Some of these are nationwide. Prices for insurance are up everywhere. Part of that's climate, part of that's other factors in the economy. Some of it's pretty localized, like the insolvencies we've seen in Louisiana and Florida following major storms, and some of it's hitting big regions and big states, like insurers stopping writing coverage in particular areas, pulling out, hollowing out the coverage provided in their policies. And in those states, that's leading to a migration of risk out of the private market and into our state programs. Let's just look at California as an example, given the recent fires. The stress in California's insurance market began back after the 2017 and 2018 blazes, which until the recent LA fires were the most destructive in the state's history. Insurers suffered very substantial losses in those fires and reevaluated their exposure to wildfire risk and how wildfire risk was changing in the state. So what we saw was a lot of insurers pulling back, not renewing policies, not offering new policies. This is the graph you see here. And the top lines are the high wildfire risk areas. That's where you saw this happening. That's where you saw the spike in non-renewals. And as insurers pulled out, what happened? People had to go into the state FAIR plan. So you see this huge spike in enrollment in the state's market of last resort. There's now over 450,000 policies in that program, and exposure in the program grew from about 50 billion in 2018-2019 to almost 460 billion this past fall. And that's having impacts on housing markets. A colleague and I have some recent research looking at what happens when insurance availability goes down and prices go up, and it's what you'd think. When you can't get insurance and it costs a lot, people choose to live elsewhere. They choose to move into less risky areas and less risky homes. And you also see it capitalized into housing markets. When availability goes down and prices go up, housing costs go down too. Housing values go down too because the costs are up. But it's not just California. We're seeing challenges in many markets, but not everywhere. And I want to stress that. There are some states that are not seeing these same concerning trends, but it's not just California. We've seen increases in non-renewals along the South Carolina coast. We've seen growth in Louisiana's residual market after their severe storms of Laura, Delta, Ida. They had a whole series. We've seen ongoing instability in the Florida market and risks across their 3-state programs. And of course, this is a number of trends, right? Part of it is changes in the hazard, which are being driven by climate, but it's also where we choose to build, how we choose to build, whether we are building with those risks in mind, and it's also economic forces, the costs of rebuilding, and the regulatory dynamics in the state. But these changes that we're seeing have led to 2 big policy questions really emerging lately. The first one, and I'm sure you've seen some news headlines with this, is the future insurable? And I think the answer to this depends very fundamentally on the choices we make now and in the very near term. Because the fact is that insurance is hard to get and insurance is expensive when risks are high. And as if you've heard all morning, risks are going up. And because we have not decarbonized at the pace and scale needed, we are locked into rising risk. And we're not going to plateau at some new risk level. Risks are going up year on year. And as you've heard, we have not adapted our institutions to reflect this changing risk that we face. 2024 was the hottest year on record, but it's probably one of the coolest that your children are going to experience. And what we do with that risk is the big question, and history teaches us that before risks become truly uninsurable, which happens when they're globally systemic, or when those tails that Spencer was showing you get so fat or uncertain that the mathematics of risk transfer actually break. Before we get to that point, it gets too expensive for people to afford. And you can't profitably offer the product at a price that consumers are willing or able to pay. And history shows us what happens then. What happens then is we create the National Flood Insurance Program. What happens then is we create our state residual markets. And those programs, which are now seeing growth in policyholders, raise our second big policy question, which is who's going to pay the costs of climate-related disasters? Most of our state programs have built into them a lot of cross-subsidies. We keep the prices of insurance lower in high-risk areas by not fully accounting for the cost of a big disaster. So when a big disaster hits one of these states and the state program doesn't have enough surplus and reinsurance to cover the losses, as has happened in Louisiana, as has happened in Florida, and just happened in California, these programs get the costs they need by putting those costs on other policyholders throughout the entire state and well into the future. So we're facing questions of, should low-risk households be paying the costs of high-risk households? Should future policyholders be paying the costs of today's policyholders? Should higher-income residents be subsidizing the cost of insurance for lower-income residents? And if we're messing with prices in this way, what is that doing to our incentives for where and how we build? And these are important questions that we have to face directly, and not just in our insurance programs, but in all our disaster aid programs as well. But I want to end with what I think is the one potential win-win in all of this, which you've also heard before, which is that we need to create insurable communities. And that's circling back to my point that our decisions today matter, because we are making decisions of where we put buildings and where we put infrastructure and how strong those are that are going to be around for decades into the future. And if we prioritize building with our climate risks in mind and how those are going to be changing over the life of these investments, as well as creating that shared culture of risk management that Spencer started to talk about, then I think it is possible to continue to create communities where insurance is available and that can continue to thrive in the face of our growing risk. Thank you.
All right. So Carolyn had 2 minutes left, so I'm going to take it and add it to my time probably. Or Matt's probably wringing his hands somewhere. But apologies ahead of time to everybody who's seen our webinar. We released a report last week. I'm taking a lot of that content, condensing it down to 10 minutes. But the top line takeaway that we had from the report was that over the next 30 years, American properties are likely to lose $1.47 trillion in value. And it really is the way in which we start to quantify some of these indirect impacts that are associated with insurance impacts, changes in the insurance market, increases in insurance cost, climate migration and climate-informed residential mobility decisions, which were also brought up a little bit earlier. But I'll walk through a few slides just to kind of highlight how we got to that number. And our primary goal with the report is taking all of this information, all of this content around the climate science, around the changing markets, and trying to quantify it into something that's tangible, something we can use and we can plug into our own models. So this chart shows the percent of the average American mortgage that is taken up by the cost of insurance. And I had a really good discussion yesterday actually about some of the drivers of this chart. We know that people are locked into low risk, low interest mortgages at this point. People are selling off their homes earlier. So we're seeing things like homes being paid off quicker and the insurance itself becoming a bigger proportion of the property. But we're also seeing increases in insurance where since the beginning of the century, we've seen the average residential property and commercial property see a doubling in the insurance costs associated with that property. So really what we're capturing in this slide is the fact that there's been these huge increases and really recent increases. I mean, even if we go back here just to 2000, it's been 2015 since we've seen these big increases in insurance costs. Those are being passed on to the consumer. And in terms of this chart, to me, is a really compelling story around the additional costs. But when you couple it with the fact that within the larger market, we start to think about how the insurance industry is sort of grappling with climate risk. Here we can see out to about 2017, the combined loss ratio for an insurance company, which is the expenses, the payouts versus the premiums that are brought in, there's about a 90% profit margin. There's a relatively stable market there. Insurance companies were making a profit in terms of the premiums they were setting. They were actuarially sound. What we've seen since about 2017 is anything but that. I mean, we've seen increases in premiums over that time period. This is on average across the insurance market. We're seeing as of the last point on this time series, payouts and just cost of business being 10.5% higher than the premiums that are being brought in by insurance companies on average across the country. So when you take those increasing rates, you can see we're still not actuarially sound. The next question is, well, what's going to happen next? Really what we're focused on is the fact that we're likely to continue to see increases in insurance. We can project these. The climate science panel before we came on talked a little bit about the fact that out through the next 30 years, risk is pretty well understood, is pretty well predictable. Here we have really high resolution zip code level data, and we're projecting at average annual losses. So the AALs associated with any given property, their property characteristics, and just their exposure to wildfire, to wind, and to hail. So just the climate perils that are captured by the home insurance policies. And out 30 years, we're seeing big increases. I mean, in Miami, this is the number for the Miami metro area as an average. So within Miami metro area, we know there are places, zip codes, that are going to see 3-4 times that increase in climate risk. In Sacramento, we're seeing big increases from wildfire exposure. New Orleans and sort of the Gulf Coast, big increases from wind exposure, from the intensity of hurricanes, as we heard earlier from our panel. But the thing to think about as you're looking at this chart and you're thinking about the increased cost to consumers, the way to think about mortgages into the future, is that this doesn't even account for flood. Flood is an entirely different policy for homeowners that have some type of flood risk. We know that the NFIP program, through the Risk Rating 2.0, adjustments already started to correct for mispriced risk, which was a big deal within the insurance industry. And we saw places like Plaquemines Parish, zip codes in that area increased by about 800% just to correct to today's risk. So if you start to think about all the mispriced risk that we have built into the market today, correcting, all of a sudden you can see this additional burden on homeowners in terms of homeownership cost. Projecting out flood, we continue to see increases in flood insurance rates. The biggest increases, as you might expect, along the Gulf Coast, the Southeast Atlantic coast, but also the Mid-Atlantic shows a place of sort of emerging risk in the area. The poleward movement of tropical cyclones as the atmosphere warms is driving hurricanes that maybe we wouldn't have seen, or they would have been a much lower probability to places like Atlantic City, where we're expecting to see an increase of about 300% in the flood insurance program. So taking all of those things together, it's not just that rates are increasing, the insurance industry knows it and is going to continue to raise rates. Home insurance rates are increasing, and then compounding on top of that, we see flood insurance rates increasing as well. And so why is it important? Well, at First Street, we started 8 years ago. Our goal was, in the beginning, let's quantify and communicate climate risk. Let's make it accessible. Let's make sure people understand what climate risk is. One of the ways in which we did that is we ended up integrating our data on the real estate platforms. Realtor.com was the first platform. Now we're on Redfin, Homes.com, and Zillow, which is our most recent integration. But for us, the integrations really gave us the ability to start thinking about how do we communicate risk and how do we communicate this really critical issue around insurance. And so if you look at the slides I have above me, on this specific property, you can actually see that there's an extreme flood factor. We give you a 9 out of 10 score, easy to understand, very critical information. But then we tell you it's in a FEMA flood hazard. We tell you that insurance is critical. So all of a sudden, all of these things that people are feeling, they're seeing insurance bills come in, they're seeing their cost of home ownership increase. And now we're telling you, when you go to buy a home, this is something you need to think about when you think about your mortgage, when you think about the cost of insurance, the cost of home ownership. Moving into the future, same thing there for wind. Here, this is an extreme wind risk property. So again, call it out. Insurance is critical for this property. You need to make sure that you have enough coverage that would cover this property. If this property were in the West, maybe you see the same thing for wildfire. But I think the key is that communication around climate risk is just starting to peak. Consumers are just starting to pay attention. We're starting to see a more global awareness around the issue. And people are responding to the information. So these are a couple of surveys that we saw. Zillow and Forbes both did a survey. They asked people, what are the most important components in terms of thinking about where you might move next? Interestingly, in the last 5, 6, 7 years, people have been saying climate. The awareness is peaking to the point that people are saying, climate is important to me, that it's at least something I'm considering. I also care about the schools. I also care about my social network. I also care about my job. But climate's important, and I'm going to put it on the list as one of the things. Well, having the data now on Zillow and having the data on the other real estate platforms, we're at a point now to where thinking about climate is becoming what school quality was 20 years ago. It's one of those things that people are starting to integrate into their thought process. They're starting to think about it as an important factor in terms of where to move, and they're able to compare properties to one another and think about this sort of the critical impact of climate and really the cost of climate more than anything else. The Redfin study that's listed here is really interesting. I mean, this was an A/B test where half the people that came to the site were exposed to the data. The other half the people that came to the site weren't exposed to the data. Ultimately, the folks that were exposed to the data systematically searched for lower risk properties. So we know in terms of search behavior, people are responding to this data. When the data's on the websites, we're now capturing over 90% of the traffic in the real estate portal market. So everybody that's going into these spaces is starting to see the data. And we've seen papers that have come out that have looked at the impact of disclosure laws on property values and then have said there is a negative impact on property values as disclosure is created. And then in the footnote, I think there was one that said, but we also can't disentangle this from the new data that's been available on the real estate platforms. So people are responding to it. There are property value responses that we're seeing in the market. And ultimately what this means is that coupling those sort of residential preference indicators along with this additional cost of home ownership with the insurance market is that we're able to start projecting out things like property value impacts moving into the future. We're isolating climate. There's a lot of different things that are going to happen in the real estate market moving into the future. But net everything else, our analysis showed that American properties are said to lose about $1.47 trillion in value over the next 30 years. Thanks.
Well, Spencer, Carolyn, Jeremy, thank you for those presentations. You've covered a lot of ground, but I think there's plenty of questions we can jump into to dig into this a bit deeper. Maybe let's start and talk about the near-term future of insurance. What do you envision happening next, and what, if anything, can be done to help stabilize property insurance markets? Would anyone like to start with that?
Want me to go first?
You go first.
All right. So I became aware, I used to do all of my research across all asset classes. And if there was one asset class nobody was interested in, it was insurance. It was just the most boring thing. And we should be worried about boring, because boring things are the things we take for granted. So nobody wanted to be interested in mortgages until 2008, when it turned out that everything depends on mortgages. And the insurance industry, and I apologize to the people here whom I'm impugning, was just super lazy. But part of that laziness was born of the roots of this physical property insurance, almost all of which just wasn't for weather. It was for fire. It was for boats. And they sort of tacked on flood and some other things into that same framework. And I think the big question in the short run is how much the insurance industry rethinks. Did we just sort of have the wrong vessel for this? Did we have the wrong framework for this? And in particular, just having one-year policies when really you want duration when you take a risk, that there's a mismatch of a 30-year investment, a 30-year mortgage, and a one-year insurance policy. Are there ways we could innovate in terms of this particular orthodox structure? I think that's the first question I would be interested in. And the second is, can we rethink who the customer is? So in the US, the customer is very specific. It's a weird country we live in. So you're supposed to buy separate policies for fire, for flood, like you are supposed to be a geoscience expert to own a home. And you could do it differently. It could be a bundled package where somebody else says, here's the kind of thing, the kind of risk you're exposed to. And it would be less of this consumer-driven arbitrage you're supposed to engage in, and just a different relationship where the pooling was at a different level. So if you think about the LA fires, should the Palisades residents have had better policies, or should the city of LA have bought a policy? saying there are likely to be fires somewhere, but we don't know if it's in the Palisades or in Venice. We don't know where exactly it will be. And so thinking differently about who the customer might be in a way that is more appropriate for this kind of risk would be the second thing I'm very interested in seeing in the short run, because they're not about price, right? They're not about what's currently regulated. They're actually about what is the right structure for these kinds of risks.
Carolyn, maybe turn it to you. How do you
Yeah,
react to
sure.
that?
I agree with everything Spencer just said. To add a little bit, I think that mismatch between the one-year policy and the duration that people are going to be in a home or of your mortgage or whatever is creating a situation in which the way that the insurance industry manages risk is not helpful to the way households or societies need to manage risk. So I'm not worried about the insurance companies in the near term. We see what they do. They shed the risk, which is fine for their financial stability, but that puts the risk on households and taxpayers and our communities and our states. And that, I think, is really concerning from a number of perspectives because many of those households are not at all in a position to be assuming that risk, might not know about that risk unless they've started looking at the scores. And so I think that calls for the need, as Spencer was saying, of some new approaches to risk management, and that insurance is risking becoming very irrelevant to the big risks that people and households and societies are facing right now. And I would like to see insurance instead pivot and lean into helping improve the risk management that needs to happen in the face of climate. And that is going to require a tighter coupling with the needed investments in loss reduction, or we're not going to be able to have any kind of risk transfer.
Maybe an analogy for that would be, I happen to know an epidemiologist who had, it was like the place where conversations went to die at the party until COVID happened. And then everybody's like, I probably should learn some epidemiology. And the idea that people who actually do risk should be teaching their neighbors how to think about risk is just absolutely so important. I mean, 2008 mostly happened because financial institutions just bought JP Morgan's risk software and didn't assign anybody to actually think about risk. And the outsourcing of risk is a huge structural problem, but there are experts in insurance, experts in these panels, experts in this room who could be teaching about risk in these other places where people have never been asked to answer risk questions. And so the insurance industry can be a locus from which knowledge goes out as opposed to the thing you just want to be as small a bill as possible or be bundled with the Kansas City Chiefs, which doesn't seem like a great strategy right now.
Jerry, any thoughts on that?
I mean, just building on what Carolyn had mentioned, I think that the mismatch is a big problem right now. I think the fact that there are one-year policies, the fact that people take out mortgages 2 or 3 years later, their insurance policy doubles or triples. All of a sudden, their fixed-rate mortgage becomes a variable rate mortgage, and it only goes up. It'll never come back down. I think those are the types of things that put certain communities in harm's way in a way that we need to price risk properly. We need to figure out a mechanism to do that, but we can't have as much collateral damage as would probably happen if we just did it overnight and corrected the mispricing of insurance.
Maybe just staying on this question a little further. You talked about maybe different ways of thinking about it. Carolyn, you mentioned sort of insurable communities, and Spencer, you sort of hinted at this in your answer a minute ago. Do you see different structures, or maybe who the customer is, to your point, as we move forward in the future? Is that a positive way for us to go? And any more thoughts on what that might look like?
So I think there are 2 ways to start at this that I think are interesting. One is to use the last panel, which is what is the resolution of climate models where they actually do particularly well. You could think about having those same, like the idea that your house has a climate is naive. You're part of a watershed. You're part of a community. You're part of a region. Those all have integrity. And I think that idea that we should be thinking less atomistically about this is actually evidence in other parts of the world. So in other parts of the world, countries buy policies with long duration for disasters, parametric insurance. I'm sure you've been involved in some of these. where you could say, we don't know exactly who's going to suffer, but we know the suffering is coming, and we'll decide after it to be able to deal with it then. And much of Carolyn's work, it points at the need for money to get in quickly after a disaster. Having each person have to go through their agent isn't a great way to do that either. So there are benefits in both ways. The pooling, the matching up with the science's own fidelity, and then the idea that you have an efficient agent dispersing money afterwards, I think are all things where we could learn from other countries, we could learn from poor countries in particular, about different market structures that would be useful to us to think about at the very least.
Jeremy, any thoughts on that?
Maybe to pick up a few examples to kind of add some color to that. I think there's a lot of interesting conversations happening right now about new ways to manage weather-related extreme event risk. And a challenge under all of them is that people still do not want to buy insurance or pay for it. And I think that's a legacy of the way risk management has been treated, but it's also a really unfun product to buy. People don't like to pay for things they hope to never use. People don't like to think about bad things happening, all of which you kind of have to do when you're thinking about insurance. And so while I've seen a lot of new models kind of be talked about theoretically, it's really hard to get them on the ground when it requires someone actually paying that premium who hasn't been paying it before or who hasn't been paying as much. And I don't fully know how to solve for that. I think creating a better culture of risk management helps. I think when we're trying to provide financial protection to more socially vulnerable households or communities or countries, we see that often that means that the public sector or philanthropy has to support some of that. So I think we're still working out the best models there. Some that I think are interesting, and I think Spencer was alluding to, are things like embedding insurance in other products that you already have to do, and that's been done globally, which takes some of the cognitive load off people and makes sure that they have the financial protection. I think another interesting model is FM Global, who have been kind of taken with lately since they really coupled the loss reduction with the insurance. And I think we need to figure out how to do that at different scales so that it's a partnership of thinking about everything you can do to lower your risk, and then you get the affordable insurance to go with it, as opposed to those being separate domains. And the last thing I'll add is I agree that there's this challenge in the US market where the approach has been to think about each peril individually, and the private market will step back from the ones that get too difficult. And then, as Spencer was saying, like the consumer has to then buy a flood policy on top of their homeowners. Oh, and you also don't have earthquake, and now you might not have as much wind or as wildfire as you thought. And that's really too much for most consumers to handle, one, figuring out all that fine print, but also paying for all those policies. And I think we're starting to see a lot of pressure that the answer to that come from a government program. And you see that in places like France and Spain, where they just mandate that insurers cover all these risks and then backstop the sector from insolvencies. And of course, they have very different risk profiles, and there's a number of reasons that might not work so well here, but I think in the coming years, there's already been a proposal introduced in Congress to have the government take a bigger role here. So I think it is very important that we have these conversations like we're doing now, because this is going to become a really pressing policy decision.
Yep. And just very quickly, I think the urgency around these different mechanisms for the way in which we think about the insurance structure is important. I mean, at this point, you can predict risk, you can understand climate exposure to properties, you can translate that into damages, we can project that out into the future, we can understand how much this is going to grow into the future. People already don't want to buy insurance. You can imagine as it grows by 200%, 300%, 400% over the next 20, 25, 30 years. We need to come up with an approach, an innovative, creative way to manage risk in a way that prices it properly, in a way that allows people to understand what that risk is. But in the absence of that, we need to understand what the risk is, and we need to understand the risk that isn't being priced in properly, and what some type of a mispricing correction might look like, what a correction into the future on that mispricing might look like. But it's really around just being smarter on the data in a way that we haven't been in the past. Again, I think we're just to the point now where we're getting this data out publicly, and people are starting to feel the pain from increased insurance premiums, but there's also now tools that allow people to understand what this data looks like at the organizational level, but also at the property level. So all of us just getting smarter on risk and understanding what the cost of climate is. Yeah.
Good points. I feel like you've highlighted a lot of those sort of short-term challenges and how insurance or risk management might change over a longer period of time, decades. Do you see anything that opportunities that open up, or is a lot of it still predicated on what we do today in terms of education or discussion around it?
So I don't know how comfortable you are with awkward silences. I decided to end that one. So I think that the big question, let's ask this question from the perspective of the one group of people who's absolutely not here, which are children. So children look forward to their lives, and the parents project forward their lives in ways that I think we need to really interrogate. So I happen to actually, in graduate school, I sat next to a woman who did probably the seminal paper on school districts and home prices. And it's admirable work empirically, it's interesting work. She's very motivated by education. She wanted to show how valuable a good school system was. But the application of it was people moving. So, I should go somewhere better. There's a different application, which is, we could improve our schools. And so this idea that that instead of thinking about this as we're all going to arbitrage, but instead this is an identification of societal risk, and as a society we're going to have a process for dealing with this. So if we take, in France, the biggest risk that's happened is heat. More people have died from heat than anything else in France. And after this giant heat wave where like 70,000 people died in the early 2000s, they instituted a heat emergency plan. And the American approach to that would be we'd have like heat tech and we'd have apps. And after a big study, the number one thing is check on your neighbors. Because almost everybody who died lived alone. And the idea that if you check on your neighbors, people don't die is an extremely inexpensive form of adaptation. Extremely pro-social. It may not be a market solution, but it has huge benefits. And so there are all these things that sort of expecting it to come out of a venture capital process, but instead is, I think, naive, but thinking about different ways that we can interact that could be very different in the future and could be really good for those kids to say, you know what, in the future, you're not all going to be all alone on your phone checking your risk. You're going to be talking to your neighbors and figuring things out. That's a process we need to start engendering now. And exactly, it needs to be informed, right? We need the numbers are going to be part of that conversation, but the context of that conversation is what am I as an individual going to do? Where am I going to go? But what are we going to do? Yep. And so more sort of we units would be a sign of a real change from where we are now that insurance got away from. Because if you think back to Lloyd's, this is why I go back to Lloyd's, at the beginning, they were all insuring each other. And then what happened was none of them were insuring each other. They all had better or worse policies. Right. And so I think that kind of a change is one of the main things that can happen once the kind of data we're talking about here is made public in a community setting.
Any thoughts from two of you on that? Well, look, let's move on a little bit. Next question, and Caroline, I'm going to target this one directly at you because you showed some interesting information up there about some of the public market programs. Could you say a little bit more about those government insurance programs? What's the evidence that they're effective, or what are the challenges with them that you see? And I'm basing that in sort of a US-based conversation.
Yeah, sure. So our government has been intervening in disaster insurance markets going back decades and decades. And I'll focus on the US, but this is true of every developed country. I don't think there's anywhere where there's a fully functional private disaster insurance market with a high degree of take-up rate. It just doesn't work. And part of it is because disasters, even before the climate stress, are very difficult because everybody gets hit at the same time. So you have correlated losses. And those losses can be very severe. They can be quite catastrophic. And that breaks basic models of risk pooling, right? And there's a lot of things that can be done to try to make locally correlated and catastrophic disasters insurable through things like global reinsurance and so on. But as we were talking about, it's often at a price point where people won't or can't pay. And when you get that breakdown in the market, in the US, we've stepped in a narrow way around the particular perils. So the federal government has been writing flood insurance to participants of, well, all the residents of participating communities, which is now everywhere in the country at any risk of flooding, going back almost 60 years now. And we've taken very different approaches for other perils. So we are the primary insurer for flood. This is a program that sits within FEMA. Private companies write the policies and process the claims, but the risk sits and the pricing is done at FEMA. But other catastrophic risks, we're talking about climate, but things like terrorism and nuclear risks also sit in the federal government. They've taken a slightly different design there. They're more of a reinsurance and a backstop. But again, risk that the private sector wouldn't take. And then we see that hurricane and earthquake risk have been picked up by the states through these state programs. They tend to be, they're not usually backed by taxpayers, to be clear, but they're created by the state. So like our state fair plans are non-voluntary associations of all the insurers operating in a state. So with the California Fair Plan right now, facing massive losses, what will happen is that all of those insurance companies will be assessed to pay the claims of the fair plan. So yeah, there's a lot of different ways that we've created these programs, and they're designed differently as well, but they face, you know, the same challenges of insuring disasters that the private market faces.
Yeah. Jim?
I was just going to add that you know they're there as a backstop, as a residual market for people that can't get insurance in the private insurance market. And the biggest problem is that when you think about distributed risk, and it's primarily all high-risk individuals that are moving into that space. There are some states where that's not the case, but they can operate in the same way that an insurance company should be expected to operate through the distribution of that risk. So I think that there's a lot of problems with the symptoms of the insurance industry not working potentially in the way that it's properly set up, not providing policies to people in high-risk areas, and all of those people having to move to the same residual market. And that could be potentially problematic, I think, in the long run, as something that, you know, we're here about every time there's an LA fire, every time there's a flood in Florida from a hurricane. The questions come up: are we going to stress test the Citizens program? Are we stress testing the FAIR programs? And those come up every time we see these catastrophic events.
Can I just add on that?
Yeah.
I think that's an important point, that these are bad risk pools. Mm-hmm. They are the highest risk properties, right? Because they couldn't find good coverage outside of it. And that raises a whole host of challenges and questions of how we deal with it. And they also are not allowed to underwrite, in the sense that they have to provide coverage to anyone who comes. Right. And that can, you know, I think it's real questions of whether we should be saying that some of the highest risk areas where it's going to be uneconomic to develop, we're not going to provide public insurance to those going forward. Those types of market feedbacks that you get in the private market don't exist in these programs. And I'll just add, a lot of the state programs were historically created in a temporary way. The programs weren't temporary, but the idea was that the insurance market is often cycling through hard and soft markets. And especially after a big disaster, if it depleted a lot of insurer capital, the market would, you know, supply would go down and costs would go up. And this was a sort of way to protect consumers from that volatility in the market. They could go into the state program, but the thought was that capital would come back, prices would go back down, and they would leave and go back into the private market. And now what we're seeing is, with permanent increases in risk, they can't just leave anymore and go back, and they're no longer temporary.
And we were talking about this. I mean, they weren't climate residual markets, right? They were for a lot of different reasons. Now California's Fair Plan is the wildfire market, essentially. It's become a climate residual market.
Just to talk about another aspect of how the government influences this. The topic of regulation in the U.S. at the state level hasn't come up, and I think I can hear my own insurance clients barking in my ear saying, well, hey, homeowners insurance is a highly regulated market in this country. What's your observation on that? I I think we're starting to see potentially some changes in how that regulation is applied. But what's your observation on the impact of regulation and what we might see going forward?
I have some thoughts on that if you
Yep.
want to jump in.
Yeah.
I'm of two minds, which is to say regulatory change is sometimes really important to create a space where the private market can play. In California, we saw that it was very difficult for the private market to offer wildfire policies because of restrictions that were put in place in the state. Namely, they weren't allowed to use catastrophe models, and you heard on the science panel how important models are now to get a handle on risk. We can't use historical data, so that made it really difficult to price policies if you couldn't use models. And you also weren't allowed to capture the cost of reinsurance in your rates. And you cannot insure locally correlated disasters without global reinsurance. You have to have it, and so that was also a limitation. So the state regulator, Commissioner Lara, has launched a sustainable insurance plan, which started rolling out several years ago, and is changing all of that. So now you can use models, you can use reinsurance, and they're trying to attract more insurers and also ask them to provide more coverage in high-risk areas. I think all of that is really important regulatory change that's needed to enable it. But it's not going to make insurance cheap, and it's not going to make it affordable for lots of people. So we still have a tension between, are we creating this robust market, but what if that market costs too much for people? We haven't really addressed that problem yet. And then I also want to say that it's my personal belief, and I'm sure there's people in the room who disagree with me, that a lot of insurance regulation plays an important role in protecting consumers. And rolling back those protections is not going to solve our climate risk problem. It's not going to make risks lower. It's not going to make risks easier to insure. And that, I think, is the fundamental challenge facing our insurance sector right now. And we need to be focusing more attention on how insurance incentivizes loss reduction to deal with those climate risks.
Maybe, unless anybody has any other comments on that?
The thing I'd say about this is the regulators, so the word that nobody really wants to talk about is politics. But this is a fundamentally political problem, because politics is how groups of people decide what's fair and what's not fair and who should do what and under what circumstances. And I would say all of those regulators were built on the assumption that the climate would be stable. Now, did they have a meeting where they agreed on that? No. But they had a sense of what the possible outcomes might be and a sense of, well, what should we be worried about? And so the regulators care about solvency and cheapness, which is a really weird thing for a regulator to simultaneously regulate, is both ends of the market. But you only do that if you think the risk isn't really changing that much. The risk is highly predictable, and whenever there's a bad year, it'll come back. And so that mean reversion, stable distribution is baked in, and it's not true anymore. And I worry that unless we have a conversation in political terms about what's fair, none of this will get better, because you'll be trying to solve. So the word fairness, even the FAIR plan is called the FAIR plan because it was fair. It's also an acronym whose first word is FIRE. It's not actually a discussed, political, negotiated decision about what the society agrees is fair. So I think some of the most interesting microeconomic research is about who is buying homes in risky places, and they are mostly politically conservative Americans who just don't believe bad things will happen, and people who are paying off their mortgages so they don't have to be told that's risky. Those are choices to take much more risk, but if those people are going to take those risks, should everybody else be responsible for them in some way? It's politics. So if I had 12 minutes instead of 10 for my talk, I would have had 2 minutes about how the thing that the whole financial market sits on top of is the vast civil society that took from 9500 BCE basically until the mid-20th century to build. And the modern financial markets rest on top of a whole bunch of things, at the bottom of which is a stable climate. So the stable climate enabled settlement, which enabled communities, which enabled cultures, which enabled governments, which enabled institutions and infrastructure, and then you get financial markets, not in 9600 BCE, but in the 19th century or 20th century. And we have to rethink what of those things that were beneath the financial markets have to change to give financial markets a chance? And so this idea that adaptation is actually about reconnecting those things, as opposed to having finance try to solve from the top, when actually it rests on these regulations that were negotiated under very different circumstances.
Maybe let's change. We talked a lot about the insurance industry. Let's move to another interesting aspect that, Jeremy, I know you focused on a lot in the recent report you did. Maybe talk a little bit further about how this current situation might change the future economics of home ownership and also the migration from climate that you all have worked on.
Yeah, and so, I mean, one of the core components of the models that we build when we think about property valuation is, one, the insurance market and understanding what we're seeing in that space, but also population shifts and how population shifts are tied to macroeconomic structures and indicators like GDP, HPI, DTI. All of these things we've been able to correlate even in historic data back to actual population shifts. So what we've done is we've taken traditional demographic models, layered in all of the components associated with location desirability, and then we layered on top of that information related to climate risk in the model. We ended up working at a really high resolution. We moved the data down to really the neighborhood level or census tract level. And what we found was when you look at that data at the county or at the state level, you miss the story. You miss what's actually happening in terms of people making climate-informed decisions today. It's already in the data. It's already in the records. And what we've seen is there are statistically significant relationships between climate exposure and population change within markets. People are looking at things like flood factors and saying, I want to live in Miami. I'm not going to move from where my home is, where my family is, where my kids go to school, but I want a flood factor of 6 instead of 9 or instead of 10, and they'll search for high ground in that case. And ultimately what we're seeing then is that people are making decisions around where to live, but it's not kind of this idea around climate migration being a mass regional migration from moving everybody from Houston to Minnesota, I think, which is what we hear all the time. It's people moving in Houston from Southeast Houston to Northwest Houston and moving across the city to where the high ground is. And so we're seeing that sort of play out, but you can't disentangle the population change as it relates to climate exposure from the macroeconomic context. I think if you're looking at places that have job opportunities, that have good school quality, that, you know, some of the things we can't measure, things like family connections, networks, things like that, people aren't leaving those markets. They want to stay in the same market, but they're looking to kind of optimize their decision given the data at a high resolution. So I think we are seeing people move around, and that has effects downstream for what happens to those communities that people end up leaving, what happens to the communities that people move to, and that can sort of impact what happens to property values as supply and demand sort of change with that equation.
Yeah.
And if you think about the implicit part of the question is that people want to be homeowners, which is why I always start with, we were unsettled for 190,000 years. And the idea that people want to be committed to a specific place for the rest of their lives or for a long time is actually very ahistorical for our species. But also there's an elegant solution to that that's called renting. And I find it quite easy to imagine a world in which there is vastly more renting and you have more sophisticated, well-capitalized owners of homes who can ask all these questions, who have less of the cognitive load, and then individuals choose to rent in a way that doesn't burden them with all of these same costs. And so it's not a forecast to embrace the theme of the conference, but it's another dimension.
Yeah.
So we've imagined this dimension of mobility and these other, one of the dimensions is the number of people who say, I want to commit to this place financially and take a 30-year loan. And the other part of that that's relevant is my biggest worry in capital market terms about climate change is that it will make duration go away everywhere. That people won't lend to municipalities for 30 years. That what you'll do is you'll say, look, your municipality's got bad future, no 30-year money for you. And the same will happen in emerging markets. And to bring this back to your mobility question, so the majority of people who live in this city, New York City, were not born here. The 2/3 or maybe even 70% of the people who live in New York City moved from somewhere else. And in terms of the people who are non-US born, which is, I think, between 30 and 40% of them, they came from places that already show up as climate hazards. And so if you look at where people are moving from, that data is already borne out in the way at the macro level. And so any conversation about the US that doesn't include the basically desertification of Central America is, I think, unlikely to look great in hindsight as having been focused on the big point. The US has a pretty benign climate. And the rest of the world's got generally a much less benign climate. And so that context, I think, should be present in this room, especially in Manhattan. And those drivers, exactly the kind you talked about, if you look what happened in Syria, you have a drought, people move into the cities. Almost when what happens is when there's a drought, people move into the city can't handle them, and then you have a diaspora. That logic is age old and is happening all over the world. And this is a place that, there are other meetings where people are everywhere in the world. People are like, yeah, we got to make our way to the US or Canada. That's the background context for this that's very different.
Right. Yeah. There was a pre-submitted question, and I think it sort of builds on this. I wonder if you have any additional thoughts or comments on how some of these changes we're talking about would impact communities across different income levels in terms of things like equity, affordability, and access. I think we've kind of hinted at that, but I know where that answer would go. But
Yeah, I mean, I think we've mentioned it, but it's just fundamentally the case that the households and communities that need the financial protection of insurance the most are the least able to afford it.
Yeah.
And they're going to be the first to be hurt when prices go up and insurers pull out.
I think this is one of the biggest costs of huge inequality in the United States, which is that there are a whole bunch of rich people who own property that could be washed away and they wouldn't care. And so actually there's an enormous amount of home ownership in this country now that is unprecedented, in that there are people living on Cape Cod or in Nantucket or elsewhere who are so wealthy that they're like, yeah, my kids won't get it, but it's not a big deal if they lose it. And so you have really risky property owned by people who don't feel any agency for it. And so there's a sense of their having self-insured, if you will. And so for poor people who are in a place where the place matters more, they're not sort of global arbitrageurs, and they can't afford it, it's just, there's a lack of connection and understanding across the community from high to low income that expresses itself in risk preparedness. And it makes you wonder whether we can create pools where both sides are involved.
Yeah, it's super interesting because there are clearly places where insurance becomes a luxury good in a lot of ways. Only certain people can afford insurance in some communities. And then there are places where if you can afford to leave, you leave. And if you can't, you're stuck behind. So it sort of creates this dichotomy of two different impacts from growing climate exposure and the cost of insurance.
So I think we've got 5 minutes left, so I'll try to end with this question to kind of maybe bring it back here to the audience. So what are your thoughts on what banks and asset managers do to protect their portfolios while dealing with increasing insurance premiums and maybe the changes in instability in the market that we're seeing? What would you recommend? You want to start? Spencer, you want to start?
Sure. So I was at an event last night where there were many heads of climate for different banks in attendance. I think it's one of the most optimistic moments of my 10 years giving talks like this, because none of those jobs existed 6 or 7 years ago. So I'll first give the first piece of advice I would say is that climate doesn't belong in ESG. Climate is its own concern, it's physics, and it should be treated not as a packaged part of sausage, but as an explicit form of literacy. And so I used to be a bank lender. I ran a small business lending program in central Russia. There was no data in the early 90s. But you could ask good questions about risk. The risks were hard to quantify, but they were not unapproachable. But I think banks need to understand that this is part of the risk process, bring in the data that they can, and then understand you're not going to have precise answers because your risk model is going to use backward-looking data that doesn't have today's climate in it. And so this idea that it's a process it should stand on its own, and that it should exist in the C-suite and the board. So if climate is ghettoized, either in a sustainability office or in some sort of barnacle attached to the bank, bad things will happen. If it's bundled with a bunch of other things, bad things will happen. But the great thing is, it's intuitive. It's actually understandable. Every one of you who's got an 8th grader who studied earth science knows plenty. It's bringing that literacy into the board. I mean, I can't imagine what a bunch of 70-year-old board supervisors are saying about AI. They have no idea. But they're not talking about the weather, which they could actually have constructive views about. And so it should be in the board, it should not be in a ghetto, and it should not be bundled. Yep. And then you should have the ability to think about risk.
Carolyn, any thoughts?
Sure. I guess my thoughts are going to be a little bit more higher level, which is insurance is clearly an area of the economy where climate change is starting to have very real financial costs in the very near term. But I also think that it's important to make sure that we don't limit our conception of climate risk to the places where we're starting to first see it materially right now, which I think Spencer was alluding to. Mm-hmm. And for instance, there are very real and well-documented impacts like we've been talking about flooding and fires on housing markets and what that's going to do to mortgage markets, and those are all incredibly concerning and we need to keep talking about them. But I'm also really worried about the risks that people aren't talking about that are going to emerge from climate. Migration's one of them that you both brought up, but also, for example, there's very real and growing risk of salinization of our drinking water in many communities all along the eastern seaboard and through the Gulf Coast. And desalinizing water is really expensive. And so what happens to the finances of those cities when all of a sudden they're facing saltwater intrusion? And we came close a little while ago in Louisiana, and then we're spared having to deal with that. But so I think we need to kind of broaden the aperture on what risks are going to be facing and what it's going to do. And then I also want to end by saying I think it is really important that everybody who is thinking about this work really hard to depoliticize the conversation around climate risk. This is not a political issue, as you've heard over and over. This is a risk management issue about the safety of our communities. And I am really worried about the politicization that's happening right now around disaster risk and the rollback of a lot of important programs that are going to help keep people safe. And so I think the more we can do to keep the focus on cost-effective risk management, the better.
Yep.
Yeah.
And I'll end just by saying I think that a more holistic approach is really what we try to do at First Street. I think understanding exposure, understanding damages are super important. And I think a lot of the products that are in the market right now are really focused on that. I think we also need to understand the larger community impacts, things like not only building damages, but property value. Understand what insurance assumptions look like in different areas. Understand how to get portfolios into those types of tools so that you can analyze your risk. But I think it really does focus on, at least from my perspective, a practical application on what Carolyn ended on. There are business opportunities. There are ways to think about this in a way that doesn't get politicized. And I think that if we focus on it as the symptoms of climate exposure, the actual outcomes that are associated with those different types of exposure, and then treating it like some other type of a risk metric, I think all of a sudden we get to a point to where there'll be a lot more buy-in and a lot more people would not push back against the word climate in that case. It becomes something that is an optimizing tool at that point.
I could just add one thing. It would just be that it's everywhere. Mm-hmm. Every climate is changing in every place with consequences for pests, for consequences for crops. And with this, it's winter time. So the Great Lakes have become far more variable in their depth. Wild swings in the depth of the Great Lakes. And the biggest reason is that they don't freeze in the same way they used to. And so there's evaporation all winter. Well, every Great Lakes community has planned its entire water system around the Great Lakes being a certain depth. And so Great Lakes are seen as a climate haven, except for the inability to manage water. And those kinds of things are not to scare you about the Great Lakes, which is my homeland, but to make you aware that this is everywhere. And this notion that this is a niche thing in any one community or any one place, it's everywhere, and that should make it easier to talk about and easier to get conversations going.
Good points. Well, I think that's the time we have, so I want to join me in a round of applause for Spencer, Carol, and Jeremy for their insights.
Thank you.
I think Matt's going to come up to the stage.